Hello and welcome back to the program. Let's start with Wall Street overnight. The three major indices all closed essentially flat. The Nasdaq finished at 26180, the S&P 500 at 7674, and the Dow at 53277. Daily moves were literally 0% across the board. This is a classic low-volume weighting pattern. Pre-market futures were also nearly flat, with the Nasdaq future down a hair and the S&P future up a hair. The market is waiting for a directional catalyst and no one is willing to commit. At the individual stock level, Nvidia slipped about 0.33% and Tesla was down a similar amount. Large-cap tech lacks direction. Crypto-related assets saw a modest pullback, with the Bitcoin ETF down 1.58% and MicroStrategy down 1.77%. But keep this in context, the Bitcoin ETF is still up over 12.5% on the 7-day window. One down day does not change the weekly trend. Overall, U.S. equities are in a phase of high-level stagnation. The fact that indices are going sideways rather than swinging wildly tells us that bulls and bears have reached a fragile temporary truce at current levels. For the A share market, the external tape offers no directional map today. Our own internal sentiment and capital flows will be the deciding factor. Now let's look at the global macro picture. The 10-year Treasury yield is at 4.71%, down slightly on the day, but the absolute level remains elevated. Yields above 4.7% continue to cap valuations for risk assets globally. The liquidity environment remains tight. The VIX printed at 15.87, up about 4.9%. It is still within the normal 15 to 25 range, but there is a hint of rising caution. The market is starting to price in potential volatility. The dollar index is at 98.95, up 0.1%. This is a modest technical stabilization after a prolonged decline, not a trend reversal. That is friendly for emerging market assets. WTI crude is holding above $85 a barrel, reflecting a tight supply-demand balance. Spot gold is at $47.30 an ounce, up nearly 1%. The fact that gold is rising despite high treasury yields tells us real rate expectations are not tightening, and a portion of capital is still trading the safe haven and de-dollarization narrative. Putting it together, the global macro environment is a moderate risk-on stance. A weak dollar supports risk appetite, but high treasury yields cap the upside. So we get divergence, not a broad rally. The invalidation conditions are clear. If the 10-year yield breaks back above 4.8%, or the VIX spikes through 20 on volume, the risk on window closes and global risk assets will come under synchronized pressure. On the yuan side, the onshore rate is at 6.71 and offshore at 6.72. The currency is stable and firm, trading in a narrow 6.71 to 6.73 range for the past week. A weak dollar index at 99 combined with a stable yuan around 6.71 is a positive combination for foreign capital flows into a shares. A weak dollar lowers hedging costs for foreign investors, and a stable yuan removes currency depreciation concerns. The macro foundation for northbound inflows is in place. On trade, tariffs, and tech restrictions, there are no newly verified events, so we are not factoring policy variables into today's trading framework. Now back to the A share market. Yesterday the Chi-Next index fell sharply by 3.21% and the Shenzhen Component Index dropped 2.13%. Sentiment is weak. But the flat close on Wall Street and the stable yuan provide a counterbalance. These forces offset each other. So we are likely to see a flat open or a small dip, and then the market will find its direction. Our base case for today is range-bound trading for both the Shanghai Composite and the Chi-Next. The Shanghai range is 3850 to 3910. The Chi-Next range is 3400 to 3500. The invalidation condition is if the Shanghai Composite breaks below 3850 on volume within the first half hour of trading, then the range-bound call is void and we turn bearish. If the Chi-Next reclaims 3500, then a repair rally is underway and we turn bullish. On sectors, the two most likely to be active today are power equipment and the power grid, and AI computing hardware. The power equipment sector did not collapse during yesterday's Chinex sell-off, which tells us capital is rotating between sectors, not leaving the market. AI computing hardware remains the strongest industrial narrative, and global tech capex is still on an upward trend. The sector already released some risk during yesterday's decline, so there is an oversold bounce opportunity today. What you should avoid is high-flying small-cap tech-theme stocks. In a market cap-driven correction, small caps have worse liquidity and tend to fall further. The risk-reward for chasing oversold bounces there is not favorable. On northbound flows, the probability favors net inflows today. The logic chain is simple. A weak dollar at 99 leads to a stable yuan at 6.71, which leads to foreign inflows into a shares. The watch signal is the first 30 minutes of trading. If northbound net inflow exceeds 20 billion yuan in that window, the trend is confirmed. If we see net outflows instead, without any currency move, that means foreign investors are actively reducing exposure, and you should downgrade all bullish calls. On individual stocks, there are no high-confidence opportunities today. Quantum computing, uranium, and rare earth themes are hot, but the data is unverified, so discipline says watch and do not chase. For existing positions, POET and COHR are stable and should be held. AEHR has fully played out its catch-up trade and we recommend taking partial profits. 5802.T and HPS.A are the weakest names in the portfolio and should be exited. Here is the core judgment for today. A weak dollar and a stable yuan offset the Chinex sell-off. Today will be range-bound with divergence. Power equipment and AI computing are the structural main lines. Probability assessment, 30% up, 45% range-bound, 25% down. That is all for today. Thanks for watching and see you next time.